Welcome to 𝘠𝘵𝘪𝘨. I'm Mr. 𝘍𝑃𝘓. I take advanced financial reporting. Today, I want us to look at another aspect of accounting for assets and liabilities known as fair value measurement. Fair value measurement. Fair value measurement. This concept of fair value measurement is governed by a standard we call International Financial Reporting Standard number 13. International Financial Reporting Standard number 13. Then you're going to write below that. You're going to write below that. You're going to write below that. Fair value refers to the price. Fair value refers to the price. Fair value refers to the price that would be received, that would be received, that would be received, that would be received on sale of an asset, on sale of an asset, on sale of an asset, or transfer of a liability, or transfer of a liability to another party, or transfer of a liability to another party. Full stop. It's not full stop, a liability to another party in an ordinary transaction, transfer of a liability to another party in an ordinary transaction between the two market participants, between the two market participants. Full stop. From the perspective of the transferring party, from the perspective of the transferring party, the fair value is equivalent to the exit price. The fair value is equivalent to the exit price, while to the receiving party, it is known as the entry price. While to the receiving party, it is known as the entry price. Full stop. Generally, the fair value should be equal to the exit and the entry price. The fair value should be equal to the exit and the entry price. Should be equal to the exit and the entry price, except in the following circumstances, or except in the following conditions. These are the only circumstances whereby the fair value won't represent the exit or rather the entry price. Number 1. Sale of an asset or transfer of a liability, sale of an asset or transfer of a liability, sale of an asset or transfer of a liability between related parties, between related parties, between related parties. Number 2. Where the transaction is effected under conditions of duress, where the transaction is conducted under conditions of duress. Number 3. Where the market in which the transaction takes place, where the market in which the transaction takes place is different from the principal, or the most advantageous market, Number 4, the fourth exception. Where the amount of account represented, by the transaction, price, is different from the unit of account, of the asset or liability, Full stop. A paragraph below that, IFRS 13 requires that transfer of assets to liabilities, transfer of assets and liabilities be recognized at fair value, full stop. However, the standard does not include the following. Number 1, the standard does not include the following. Number 1, IFRS 2 into brackets share-based payments, It is not covered by that standard. So these are the items excluded by the standard. The other one is IFRS 16, which is accounting for leases. Again, it doesn't cover IAS 2, which is accounting for inventories. And IAS 36, which is impairment of assets. So all the other items are covered by this standard except those 4. Those 4 items are not covered by IFRS 13, which is on fair value measurement. So IFRS doesn't cover those items. So I want you to write below that Valuation techniques and a fair value measurement. Valuation techniques and a fair value measurement.